Welcome to This Week in Money. I'm Phil Mackesy. Today, Garth Turner looks in on Canadian real estate. Mike Swanson checks the U.S. market for us. And Jeff Berwick on a new kind of money. We begin with Garth Turner right after this.
He Touched Me, the Gospel Show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Author, entrepreneur, financial advisor, and blogger Garth Turner is back on This Week in Money. Garth's latest book is Money Road, Tools for the Wild Ride Ahead. Garth's blog at greaterfool.ca. Hey, Garth, it's good to have you back.
Thank you, Phil. Pleasure to be here.
Want to wish a happy 5th anniversary to the blog, and a nice touch having Missy Bunny there to blow out the candles for you.
Yes. You know, these 5 years since I started that ridiculous blog have been most interesting because pretty much chronicle from 2008 when everyone thought, man, this real estate market's going to the moon. And then, of course, the whole world collapsed in the financial crisis. And then it's been, since then, craziness in Canada and despair in the rest of the world. So chronicling that and all the eccentricities that have happened, especially in the crazy Vancouver market, man, it's been an interesting ride.
Boy, it seems like a much simpler time, doesn't it? Those happy days of zero down payments and 40-year mortgages. We thought they'd never go away.
Yeah, well, I still remember being in Parliament when Flaherty brought that stuff in, and it shocked me then, and now in retrospect, it shocks me even more. I don't know what the government was thinking, other than, you know, if a real estate bubble helped the U.S. economy, great, let's have one here. But the trouble is, of course, they always blow up. And it's been a slow deflate in Canada for a number of reasons, but deflating it is, and there's just no doubt that this is going to continue. So 5 years of having promoted housing as being the big economic policy of the government has ended up with houses that most people can't afford and debt levels which, of course, are historic. So it's going to take some time to unwind all of this.
Garth, speaking of deflating, this is not good news, especially from a major lender. TD making news that they're expecting prices to fall for the next couple of years and then to level off around 2% for the next decade. They're calling it, and the economists everywhere will love this one, they're calling it a gradual, modest downward adjustment.
You know, I call it a lost decade. For a lot of people who have recently got into the housing market, having houses go up just around the pace of inflation is probably what one would expect to be normal. Of course, that hasn't been normal over the past 10 years. We've had relatively stagnant prices for most things, and houses have pretty much doubled in value. So it's been an extraordinary time. So getting back to, you know, like modest house growth, is that good? Well, maybe under normal circumstances, but we're not coming out of normal times. We have had so many young couples, for example, who have bought hundreds of thousands of housing units with 5% down over the last 3 years. And of course, they did that because they thought things were going to continue to go up in value. In fact, that's the only way it actually makes sense. Because if you put 5% down on a condo that's $400,000 or $500,000, you're going to end up paying about twice per month what it would cost you to rent the same unit. So there's no advantage to doing that unless capital value of the unit continues to go up. Well, those days are gone. I know that. Now Toronto Dominion Bank is agreeing in a major study. This is bad news because it means basically that those people who put 5% down are never going to get out from under this burden. And 5 years from now, when they come up to renew that mortgage, which they got at 2.99%, I'm certain it's going to be 5 or 6%, which means house prices will be declining. This is not a good situation, Phil, and people have walked into it pretty much based on rose-colored projections made by our self-interested friends in the industry.
Garth, what do you make of this in the fine print of the TD report? They say Calgary will be an outperformer. So will Edmonton, Vancouver, Victoria, and Toronto. So where is this gradual downward adjustment going to happen?
That's a good question because you've got, you know, Montreal, Vancouver, and Toronto, basically the 1, 2, 3 biggest markets in the country, and they really dominate in terms of statistics. Calgary may or may not do okay. I'm a bit worried about Calgary. They've had a lot of price appreciation. It's been running a couple of years behind Toronto and Vancouver. Of course, what really worries me is the popular delusion in Calgary right now that, hey, you know those favorite three words, Phil? It's different here. And, of course, everybody in Vancouver in 2008 to 2010 or 11 said, it's different here. Well, it's not. It's not different anywhere. So, oil prices don't start rocketing higher. I think you're going to see some trouble. Alberta, of course, the economy is not great shape. Government revenues have fallen by 47%. The province is going into deficit right now and has just brought in an austerity budget. What are the Cowboys smoking?
Hey, let's check out the godless GTA. Here's a thing from skyscraperpage.com that got my attention in the Globe and Mail. 144 towers under construction in late February in Toronto, more than any other city in the world.
That's amazing, isn't it? It's more than you can take, New York and Chicago and lump them together as, major cities in the U.S. Eastern Seaboard. They don't even come close to what's happening in Toronto. It's scarier than that. It's scarier than 147 buildings being built. There are now 21,000 condos in Toronto that are new, constructed, and empty and unsold. There are 53,000 more on top of that are in the pipeline that are either being designed, marketed, or built at this time. There are 6,500 condos for sale on the resale market today, owned by existing owners. Well, you put all that together, it is a recipe for collapse, and it is going to happen. So condo prices in a market like that have the potential to fall 20 to 40% in certain areas, and it's already starting to happen. So again, all those young buyers, I feel bad for them. They were naive. They believed what Remax and Royal LePage and CREA and the Toronto Real Estate Board told them, and they went and bought something they thought was a no-brainer. Well, too bad. They're going to learn.
Garth Turner, our guest here on This Week in Money. Last week, the Bank of Canada said it would keep rates at 1%, no change for more than 2 years. It's the longest period since the early 1950s. And I love this spin, Garth, from the folks at CREA. An indication the bank is becoming more comfortable with consumer debt and the housing market.
Yeah, no, CREA is certainly bending that one a bit. Obviously, the interest rates are staying where they are because the economy sucks. I mean, let's call a spade a spade. Mm-hmm. We got inflation right now that's 0.5%. That's below what the bank wants. They want somewhere between 1 and 3. So, in other words, we're closer to deflation than inflation. That's not good. Gross domestic product, in other words, the economy, it shrank in December. It was down. It was negative. And for the last 3 months of last year, it only grew by 0.6%. Okay, all of that, like I said, it sucks. The economy is really slow right now, and that's why interest rates cannot go up. So everyone's trying to put a little bit of a positive spin on this, but until we get the economy moving again, rates will stay low. The thing is, though, it just doesn't matter anymore. You can get a mortgage today for 2.99% at Bank of Montreal, 2.95% at Scotia and other lenders. It is not having any impact on the real estate market or on demand for new credit because people are tapped out. They can't borrow continuously. We've already hit the ceiling.
Garth, we know from reading the blog that sales are down almost 30% in Vancouver and Montreal, 15% in Toronto. How are sales going to be different this spring from last spring? What's changed in a year?
Well, what's changed is demand has gone down, even though inventories are low. So there's not like a flood of new listings coming on the market. This surprised me a little bit, but that's the reality. People are just hanging on to their homes because they think the market is soft, so they're not listing. So we don't have as many listings as one would think, but demand has fallen even more precipitously. We all know the reasons. Those 30-year mortgages were murdered off by Flaherty last July. So that hurt the bottom end of the market, and CMHC stopped offering housing insurance or mortgage insurance on listings over $1 million. Well, that sure kicked the Vancouver market in the stomach and certainly half of the Toronto market. So the bottom and the top of the markets have really been hurt. So the activity we're seeing now is more in the middle of the market, and that in Toronto and Vancouver is going to be $700 to $1 million. That's where you're getting more activity. But overall demand is down. It's just that simple. And Phil, it's going to get worse. So those sales figures you mentioned, they're for February. The real interesting story will be March. Mm-hmm. Why? Because March of 2012 was the time of national delusion. It was when we had the greatest sales happening in major markets, the sort of the height of the spring market, and the crest of prices. So I think you should expect some pretty big decline numbers relative to last March when they come out a few weeks from now.
Garth, what about the demographic angle? All those millions of wrinkly boomers who realize that they do not need stainless steel and granite, they need income.
Yeah, absolutely. Well, I've been on that bandwagon for a while, and we continue to see more numbers that come out to support that. Certainly during RSP season, the banks all go out and interview people to persuade us to stick our money in retirement savings. It's not working anymore, by the way. But those surveys found that in Canada, we've got 40% of people just around retirement age don't have $100,000, which is shocking. I mean, $100,000 may seem like a lot when you're 25 years old, but when you're 65, forget it. Because 70% of people don't have pensions anymore. They need to amass a pot of money in order to survive the next 25 years of their life. So Canadian boomers are not in good shape. However, at the same time, according to our friends at Royal LePage, we have 78% of boomers actually own real estate.
Wow.
Well, now the picture becomes clear. Now we start to see where people have their net worth. And clearly, they are house rich and asset poor. That leads me to the inevitable conclusion that we will see a lot of homes have to go on the market, not necessarily this year, but over the next 5 to 10 years. It's estimated about 3 million boomers out of 9 million will have to downsize, sell, rent, do something. In other words, get rid of their houses. That's going to put a lot more homes on the market, and many of them are going to be big particle board McMansions in suburbia. I regret to tell anyone who's living there now what that's going to do to prices.
Garth, what about the ham factor, hot Asian money? Here's Conference Board of Canada economist Robin Wiebe says strong links between Vancouver real estate and China's economy.
Yeah, well, I'm a cynic. I've been a cynic for a long time. I think hot Asian money, there definitely was an influence, and particularly in Vancouver, particularly in certain segments of the market, in other words, at the top. It doesn't take a lot of people coming from China to buy $8 million properties in Shaughnessy to really make a big impact on the market, and an even bigger impact on the mental state of most people in the market. And of course, when it got huge media coverage, a lot of it pretty fake, but nonetheless, it was there. I think hot Asian money has been way overblown as a significant factor influencing the market, and I just don't think it's there to make an impact long term. It's much more significant what happens to the average buyer and the average family right now. So I tend to think that some of those studies are done just for media value and to try and get people thinking, man, if I don't buy that, some rich dude from Guangdong is going to come and buy it instead of me. And I think that's what the whole intent has been. Here's
a perfect example, Garth. Latest from British-based real estate consultants Knight Frank. They say in 10 years, there'll be 50% more wealthy people, and that, of course, means more demand for high-end real estate.
Yeah, well, I wonder what they're smoking, too, because, last time I looked, the economy of British Columbia is not exactly on fire, as Christy Clark's going to find out when she gets the courage to call the next election. So I do think that is just puffery. I see no indication right now that we're going to have the massive accumulation of more wealth. Yes, wealth is certainly concentrating more at the top. The top 1-2% of Canadians are getting more wealth proportionally than the bottom 80%. There's no doubt about that. But 50% more wealthy people? No, I don't buy it. And the wealth is not going to be created through real estate over the next decade. We're seeing actually a fundamental shift. Now, to more wealth being created through entrepreneurship, through small business, and through the capital markets than we are in real estate. Those days are behind us, and I think guys like that should get with the program. But obviously, once again, it's in their own interest.
Garth, folks who visit your blog know what to do by now, but tell us again why we should be balanced and liquid in 2013. What do you see ahead?
Yeah, well, my three little goals in life are for everybody to be balanced, diversified, and liquid. When I say balance, you don't just want to, go off and buy a bunch of stocks. You want to make sure that you've got fixed income, safe stuff in your portfolio, as well as growth assets. That just makes sense because you're hedging against volatility. And diversity, well, take a look. The U.S. market went up 13% last year. Toronto market went up 3%. So obviously, most people have most of their money in Canada. That's a big mistake. You not want to have diversity among all these different asset classes as well as geography. And liquidity, well, what happens if that nut in charge of North Korea decides to send a missile into the U.S.? I know he won't. But, it's a good example of how volatility can be there around any corner. And you want to be liquid. In other words, don't get yourself locked into long-term assets. Don't be satisfied with 2% on a 5-year GIC. You always want to be liquid. If the world blows up, you want to be able to go to cash in 5 minutes. If opportunity comes along, you want to be able to jump on it.
Author, blogger, financial advisor, and entrepreneur Garth Turner is our guest. You can find Garth on the web at greaterfool.ca. And don't forget to follow Garth on Twitter at Garth Turner. Garth, thanks for talking to us today.
Pleasure, Phil. Thank you.
This Week in Money is archived online at talkdigitalnetwork.com.
Mike Swanson is founder and chief editor of Wall Street Window. He is online at wallstreetwindow.com. Hey, Mike, it's good to have you back on This Week in Money.
Yeah, thank you. It's great to talk to you.
All the headlines today about the S&P and the Dow, they're in record territory. We are just below the all-time peak of the S&P set in October 2007, and the market seemed kind of split. People saying we ought to run away, and a lot of folks saying that this is a great time to get in. What do you see from where you're sitting?
Well, I don't know if I'd say it's a great time to get in. I like to buy in corrections and pullbacks and not, when things are making new highs. So I would tell people wait to sometime this market will pull back 5% or even 10%. Last year it did it twice, and usually it does it at least once a year, even in bull markets. That said, I see no sign to suggest that the bull market that began in 2008 is over at all. I don't see a single sign to make me say that. And in fact, normally when a bull market ends, you get all sorts of divergences in the stock market, meaning that typically what happens is the number of stocks going up narrows, only a few go up, and most stocks just kind of do nothing or start to turn down, and that's can go on for months and months, and it hasn't even started to happen yet. So I don't think the bull market's going to end this year, probably won't even end next year. And to top that off, most of the time when bull markets do end, it happens after the Fed raises interest rates several times, and of course they're not going to do that either this year. So, so there you go with the stock market. But that said, I'm speaking of the United States stock market when I've been saying all this. It is overvalued on a fundamental basis. The cyclically adjusted PE ratio is for 20, and you can buy into markets around the world that are at much cheaper valuations, and I think will go up much more going forward too. And I know a lot of your listeners are interested in gold and gold stocks, and those are at extremely cheap levels, and they've in fact declined now for almost 2 years. So, I think they'll bottom out and turn up, and once they go into a new bull market, they can go up 100% or even more in a space of a year. So I think that's where the money to be made now is.
Something we've been talking about for a while, the distinction between what the gold stocks are doing and what the big markets are doing. And I wonder, as a newsletter writer, Mike, how do you thread your way through the psychology involved here? How do you keep your people on track?
Well, I try to tell people to invest in things that are in bull markets and, have a lot of room to run. And what's happened there is, even though the United States has been in a bull market since 2008, in 2011, just about every other market in the world made a top and went into a bear market that ended last year. If you look at, for example, the European markets, of course, they all collapsed last year when that Greek debt crisis blew up. China had gone into a bear market. Just about every market in the world, and gold and commodities did the same thing too. The difference is that these European markets and Asian markets, they all bottomed out last June and in my view, are in new bull markets now. They're going up and doing good. The gold and commodities haven't yet began a new bull market, but I think they will, sometime next couple months. And so I'm telling people, if they are holding U.S. stocks or whatever, don't worry. And if they've got new money to use, now is the time to be looking at the mining stocks and commodities in general.
Mike Swanson from Wall Street Window, our guest here on This Week in Money. You're looking at the VIX, the Fear Index, Mike. It's down around 12 earlier this week, hitting its lowest point in 6 years. Is volatility going to be part of the landscape for a while here?
Well, I think it's almost exactly the opposite in a certain sense. What's going on is the United States, the S&P 500 and the Dow, you're right, they did make the Dow did make a new all-time high the other day, but when you have a bull market, and this one's been going on now for several years, typically what happens is at the very beginning, in the first 6 to 8 months of a bull market, you get huge gains real rapidly, something like 30% or even more. And if you look at a chart, you can see that's exactly what happened to the Dow and the S&P 500 in 2008. And if you look at something like, say, Greece, the Greece stock market, it's been up like 60-70% since last June. And but then what typically happens is when you're in these bull markets, after these big gains happen in the first year, the gains shrink, and then you're up like 5% a year, 10% a year, and the corrections are smaller, and the volatility in general just kind of disappears. And there's a bit of an illusion. Like if you think about the U.S. stock market, it hasn't really moved that much on a percentage basis up and down for the past year. That's typical of a mature bull market, low volatility and small corrections, and things just kind of die out. And then at the end of a bull market, though, you can often get another big blow-off of excitement and mania, but I don't think that's the case yet.
Mike, we know what's driving U.S. markets. It's mostly, according to analysts, corporate earnings and all that QE from the Fed. And so that's what's happening in the States. How do you explain what's happening in Europe? Here's European shares this week hitting a 5-year high.
Well, the thing about Europe is, see, a lot of, I'm invested in Europe, and I'll just say that flat out. I bought in like several months ago. And when I did that, the European economy was shrinking. And there's still many economies over there that are in a recession this year. So it's hard for people to understand how can it go up if the economy is bad. But the thing is, stock markets tend to look 6 months out, and next year these economies should be growing. Even the Greece economy is supposed to grow 4 or 5% next year, which that would indicate this is like a recessionary or depressionary trough right now, the first 6 months of this year. But the real key and important thing, the most important factor, though, when it comes to these European markets, is the valuations in Europe is simply extremely low. When the U.S. stock market has a cyclically adjusted P of 10, which that's, for the listeners that don't know, that's a average 10-year price-to-earnings ratio adjusted for inflation.
Okay.
It's a better indicator than just using a 1-year PE, which can change, it's real volatile. So the U.S. is at 20, which is historically overvalued. 15 is the median. Well, Greece has a cyclically adjusted P of 3. Ireland of 5. Italy and Spain of around 8. Russia around 8. And these markets are incredibly cheap. To put it another way, if you wanted to go buy a business, say a McDonald's or something, a restaurant in the city you live in, and you looked at the books, if you go do a business transaction like that, you're going to ask yourself, what am I going to pay per earning? So if a restaurant makes $100,000, am I going to pay $500,000 for it? And then, pay it all off in 5 years and then start making, a big profit.
Mm-hmm.
That's typically what you look at when you buy a business. Well, you can buy the Greece stock market basically for 3 times earnings. So the bottom line is these markets are incredibly cheap, and that's the real reason they're going up and can go up even more. The U.S. is, like you said, money printing and all that, so who knows? It's overvalued. So you're just playing the momentum to justify doing that, which that's fine, but that's not in my book real investing. Real investing is buying fundamentally cheap stuff, and the gold stocks are and also in that category. Newmont, Berwick are now paying 4% dividends, so it's there. The opportunities to invest are there. You don't have to just buy thinking, well, let's play the momentum and let's hope the Fed prints and believe in that. No, you can buy on fundamentals, in the right places.
Mike Swanson from Wall Street Window here on This Week in Money. Let's talk about our favorite shiny metal, Mike. Gold, only a few points away from a 20% decline. Generally, they think that's a bear market. What's going on with gold?
Yeah, I actually would call it a bear market, but I would call that a cyclical bear market that's been going on for 2 years in the context of a secular bull market, which has been going on since 2002. And I think the little bear market since 2011, the 20% correction is about over. And we've seen 2 or 3 of these. This is the third one since 2002, and the last 2 when they ended, gold skyrocketed. And I think the same thing's going to happen. I think we're probably at a bottom and probably churn for a couple of weeks or maybe even 2 or 3 months, and then turn up. And I think people are going to be left behind that are too scared to invest now or been selling or whatever. And we've seen a couple giant legs up in this bull market, and when they start, people can't believe it, but it's coming.
Mike, give me a technical look at what's going on here. Gold and silver in a pretty tight trading range most of the month. The conventional wisdom says investors are dumping metals and buying stocks. Is that what you see?
Well, I don't know if they're necessarily. Here's what I think is really driving to selling. I don't really think it's necessarily individual investors. A lot of the individuals probably already got out.
Okay.
The real problem is institutions tend to chase momentum because they're graded on a monthly time basis. The hedge funds, for example, get most of their money from Wall Street institutions and fund to funds and so forth, and they check them on a monthly basis, their performance. So if they start to lag, they move the money out and give it to whoever's hot. And that's caused a big problem for hedge funds invested in gold because gold's declined. They're lagging the regular benchmark averages, and I think that's caused them to sell. We've seen stories about that Swanson hedge fund that has had to meet lots of redemptions. And 2 weeks ago, the GLD ETF saw the biggest outflow of money ever. We also saw the Commitment of Traders report also report that the speculator positions had the biggest 1 week of liquidations ever. So there's obviously been some real panic selling in gold or forced selling, and that also typically happens at the end of a bear market or end of a correction. The sentiment gets so negative that people don't want to be anymore. And you can think back to 2008 in the United States. That's how it was. Or even last year in Europe. In the summer, Europe was somewhere we were told on CNBC to stay away from it, to be terrified to invest there, that it's hopeless. And that was the bottom. And now there's some people saying the same thing about gold, but they're going to be proven wrong, just like it's what always happens, at these extreme times.
Mike, for folks who want to check out what's going on in the markets and take advantage of your expertise, tell us how Wall Street Window's Power Investor Service works.
Well, my website's Wall Street Window, and there's a lot of free content on there, actually. Yeah. I post something every single day, and people can get that for free. But there's also a pay service, the Power Investor Service, and I keep that just to about 1,000 people, and it has weekly PDF reports and also monthly calls where people can call on a live conference call. And, we talk about the markets and like we're doing right now on the phone, and do it all live and share ideas. Mike
Swanson, founder and chief editor of Wall Street Window. You can find Mike online at wallstreetwindow.com. Hey, Mike, thanks for this.
Yeah, thank you. I really enjoyed it. It's good to talk to you, too.
After the break, Jeff Berwick on This Week in Money.
He Touched Me, the Gospel Show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Jeff Berwick is back with us. He is founder and chief editor of the Dollar Vigilante. It's a free market financial newsletter, and Jeff is online at dollarvigilante.com. Hey, Jeff, it's good to talk to you again.
You too, Phil. It's been a while.
We have not talked in a couple of months. We know you've been busy. You're just apparently back from Belize. What was going on down there?
I was there for another conference trying to spread the word about internationalizing and freeing your assets from the state and international banking and things like that. It was for a conference called the Global Escape Hatch Conference, and it was very nice. It was all on the beach. We were just in flip-flops the whole week, so that was nice.
Now, this is standard fare for folks who are Dollar Vigilante regulars. What is the attraction with these conferences? They're different from all the other financial conferences that we normally talk about here.
Yeah, the conferences that we normally talk about are usually resource or investment conferences. These are slightly different, although there is quite a bit of talk about investment. It's more on internationalization and getting your assets outside of your own country, as well as your own self, second passports, things like that. It's more for people who are starting to sense that the collapse of the Western governments are coming and how to protect yourself from that, including over the last few months, the U.S. government has even talked about in Congress about nationalizing IRAs. So that's the retirement savings, similar to RRSPs in Canada. And I'm sure Canada will eventually go down that same route as well as their tax revenue continues to decline as we head into this Greater Depression, as these governments continue to print money, that they're basically destroying their own economies. And so as these governments continue to go down, they usually look to take more and more from their own tax citizens. And because of that, many people are starting to wake up that they should look at options outside of their own country to protect their assets.
You can sure see, Jeff, how this ties in with what we talk about all the time, that it's not just enough to save and invest your money. You've also got to protect it from all kinds of bad guys, including our own governments.
Well, they're always your number one threat. You look at just the tax rate. The tax rate in many states in the U.S. is over 50%. In France, the top tax rate is 75%. So right there. And there's so many ways, especially as Canadians, that you can get your income outside of the country and become a resident of another country. And you don't necessarily even have to live in that country, but you do have to live outside of Canada for more than, I believe it's 6 months of the year, or maybe more than that. And you can actually not have to pay Canadian taxes. So that can be quite the savings to some people, as you can imagine.
Now, the good news is you have another conference coming up in May in St. Kitts. Where is that? And tell me a little bit about the conference.
Yeah, well, I've never been to St. Kitts, but I hear it's in the West Indies. It's in the Caribbean, and it's called the Liberty Forum. And I'm really looking forward to this one because I get to hang out with two of my favorite people, Doug Casey, who's often on your program, and Rick Rule, who's a really intelligent guy. And both of them are amazing, freedom-loving people who are basically taking advantage of speculating on the state and their inflation and where the money's going to go in various bubbles. And so I'm really looking forward to that. And there's going to be all kinds of excellent people there, including There's Bud Conrad of Casey Research is also going to be there. He's really a great speaker. And many other sort of internationalization experts. It's a similar type conference in that many people will be going there to hear about other investments and other ways of getting their financial assets in order and to find ways to save on either taxes or on ways to protect their assets.
Now, we know you're going to this. What are you going to be doing there?
I'll be doing the same old thing that I'm always doing, but there's always so many new things to talk about that it never gets too repetitive. There's so many things happening, and I see the collapse of the U.S. government just happening in real time right now. They're doing so many things almost every day to restrict capital, to put in new regulations, to increase taxes. They're instituting new laws at hundreds a day, really increasing the police state. And so many people, again, will be going there to find out options and opportunities. And we also learn from them as well, because so many people come from around the world and they've got ideas and places that they've found that they can invest in and things like that. So it's really interesting.
Where can I find out more info on Liberty Forums?
I believe it's just libertyforums.net.
Jeff Berwick from dollarvigilante.com coming to us today from sunny, warm Acapulco. How is it down there today, Jeff?
Well, I'm actually indoors today. I'm normally outdoors. It's a little windy. This is the worst weather we've had in about 6 months. It's about 28 degrees, but just a little windy.
Still a lot nicer than rainy, wet, cloudy, miserable Vancouver, right?
Definitely.
Hey, while we got you here on This Week in Money, I want to congratulate you on a big moment for you. Your newsletter's third anniversary. 3 years. Congratulations, buddy.
Oh, thank you. Yeah, it's been quite the ride. We really started off not knowing if there'd be enough stuff to write about every day, and now there's just so many things that we've had to increase the offering substantially just to keep up with all the things going on, not just in the U.S. or Canada, but around the world with different countries instituting new taxes or regulations or capital controls and limiting people on the way they can get foreign passports. So yeah, it's been quite the ride for the last 3 years.
How did the newsletter come about? What was the original idea? We know you're an anarcho-capitalist. How did you come to think of the Dollar Vigilante newsletter?
Well, I had been studying Austrian economics for a number of years, and I was predicting the housing crash, and I was predicting a major crisis in around 2008. I didn't pick the exact year, but I knew it was coming. And so when that happened, I really started to realize that all of my studying and thinking about that for the past decade was really starting to pay off, and that I really understood what's going on, and I wanted to get the word out there more. And the way the word dollar vigilante came about is that in the old days there used to be bond vigilantes, and what they would do is if a certain government was spending too much or inflating their currency too much, they would sell their bonds, and they were called bond vigilantes. Well, today the biggest buyer of U.S. government treasuries is the Federal Reserve, the central bank itself, which is completely ludicrous. And so there is no way to show your disdain or dislike or even a profit from the amount of inflation and overtaxation and things like that by selling bonds anymore, because the central banks will just buy them now at 0% interest rates. So the only way to really profit from this coming collapse that I see coming in fiat currencies, and also to protect yourself, is to sell the fiat currencies themselves. So we came up with the name Dollar Vigilantes.
Jeff Berwick is our guest. The show is called This Week in Money. And Jeff, here's a new kind of money, Bitcoin. It's a new digital currency. Here's the deal. You can instantly pay anyone, anywhere in the world with no central authority. No wonder everybody hates it.
Yeah, well, not everybody, but the government certainly does, because it's unregulatable and it's untaxable, and it's almost impossible to even shut down. As long as the internet still exists, Bitcoin will still exist, and doesn't actually exist in any central area. It's on millions of computers around the world, and it's really changing the paradigm on money. And it's really fantastic. I've been spending about 3 or 4 months just opening a bank account offshore. All the documents you have to fill out, they have all these know your client things. It's just a massive amount of hassle. To open a Bitcoin account, it takes about 3 seconds. And within 3 seconds, if someone knows your Bitcoin account number, they can transfer in Bitcoins. And within a few seconds, you can already have those transferred off or buy things with it. It's amazing. The more that people find out about it, I think the more they're going to like it.
Now, Peter Schiff may not like Bitcoins, but over at HuffingtonPost.com today, Max Kaiser asking, is Bitcoin money? And he says it's got to meet 4 conditions. Let's walk through them. Number 1 condition, is Bitcoin durable?
Well, those conditions were brought up by Aristotle hundreds thousands of years ago. So I don't think any of them necessarily have to be that way anymore, but we can go through them anyway and just see how Bitcoin stacks up.
Let's start with durability.
Of course, because unlike wheat, that's why wheat isn't a good money, because it will rot in a number of months. So Bitcoin is definitely durable.
Is it portable?
It's definitely portable. You can access it anywhere there's an internet connection, which is pretty much everywhere on Earth right now.
And the third one, is it divisible?
Well, it's divisible in the sense that there's a certain limited amount of Bitcoins that will ever be created. I believe it's 21 million Bitcoins total.
Okay.
And so what will happen over time as more wealth is created, that prices will actually just go down. And yes, I believe Bitcoin is divisible up to the 8th digits, which would mean one Bitcoin today, just so you know, it's trading today around $49. So if you divide that by 8, that means that you can break the Bitcoin down into fractions of a penny.
Here's Aristotle's fourth condition, courtesy of Max Kaiser. Does it have intrinsic value?
This is the sticking point on if you're going to use Aristotle's definition of money. It doesn't have intrinsic value, but neither do fiat currencies. So for people who think that the U.S. Federal Reserve note, is money, they should look at this definition of money. It definitely doesn't have intrinsic value. And in fact, I believe, as a dollar vigilante, that in the next few years, the dollar will reach its intrinsic value.
Max Kaiser, Jeff, felt that Bitcoin did have intrinsic value, and he thought the intrinsic value was kind of an intangible, and that's something that you wouldn't recognize right away, the privacy value.
Oh, that's very interesting, yes. There's definitely a lot of benefits that Bitcoin has that other monies don't. So you can almost add to that list if you wanted to, the things that would make a good money. And Bitcoin definitely ticks the box on a lot of things.
Had a bit of a scare this week on Tuesday. Bitcoin exchange suddenly losing a quarter of its value. They say it was a software problem and things back to normal. Last weekend, hackers breaking into another Bitcoin transaction services company, BitInstant. They stole $12,000 and nobody was affected. Is there any way to protect myself here in the world of Bitcoin?
Oh, absolutely. And the thing that people should understand is it's not a problem with Bitcoin that is the problem. These are places, banks, although they're virtual, they're the places that can be hacked. They can be broken into just like a regular bank, and you have to protect in those senses. But Bitcoin, you can have just on your own computer. You can have it encrypted with just a password that only you know. And as long as that's the case, then no one could ever get access to it. And you can actually back that up in other places around the internet in case you lose your computer. Because if you just have the Bitcoins on your computer and you lost your computer, those Bitcoins are gone.
Okay.
So that is one important thing. And that's why there is a good case to be made for having Bitcoin banks. But of course, just like any bank, there can be problems with people hacking into it and stealing things. So you have to be careful for sure. This is an evolving currency right now, and there's definitely going to be a lot of a learning curve.
Jeff, we were kidding earlier about everybody hating Bitcoin, but it is obviously a threat to the credit card companies most of all, right?
Oh, absolutely. You wouldn't use credit cards if everyone accepted Bitcoin. There'd be no reason. And also, the credit card companies always take about 3% or more on every transaction, so you would save that as well. And it's, of course, more private and more secure and easier. There's no way to... all the problems that credit cards have, you don't really have those with Bitcoin. So definitely the financial system and the central banks are all looking at Bitcoin and trying to figure out how they can destroy it. And but there really is no way to do it except for propaganda and trying to just get people to not use it and try to scare them away from using it. But the more that people use it, we'll have a much better, much easier, cheaper, a safer, more private financial system.
You can find out more on Bitcoin at bitcoin.org. Jeff Berwick is founder and chief editor of the Dollar Vigilante. He's online at dollarvigilante.com. Don't miss Jeff at Liberty Forums. Doug Casey, Rick Rule, many others. That's at St. Kitts, and you can find out more at libertyforums.net. Hey, Jeff, good to talk to you.
You too, Phil. Thank you.
Thanks to our guests, Garth Turner, Mike Swanson, and Jeff Berwick. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.